Hi guys, in today's video I'm going to go ahead and answer the question, is the U.S. housing market as risky now as it was in 2006? As a matter of fact, let me go ahead and answer that question right now. Yes, absolutely it is. And right now I'm going to give you my top 5 reasons as to why. Let's dive right in. Reason number 1, the U.S. has more mortgage debt today than it did in 2009. We start off in 1950 and the mortgage debt stays pretty much the same until we get to 1971. That's when we went off the gold standard. Then it starts to increase gradually till we get to 1981, and that's when we started the interest rate bull market, where interest rates went down for 40 years. More on that later. And then we get up to 2000, it really starts to go up. And then in 2009, it hits that peak of 14.5 trillion. Today, there's $15+ trillion in the U.S. mortgage debt market. And as we know, the housing crash in 2009 was a result of a debt bubble. In today's market, we've got even more debt. Number 2, we've got median incomes relative to home prices. Right here, I've got the SHILLER 20 City Index versus real median income. This line at the bottom are real wages, or real incomes. That's adjusted for inflation. And you can see that goes up a little bit, down a little bit, up a little bit, stays pretty much consistent. This line is the SHILLER 20 City Index of home prices. As you can see, we've got a massive divergence starting right here, going up to a peak at 2005. Then that goes down as home prices go down, but wages go down less. And then it climbs back up to where we are now at a level higher than where we were in 2006. So that means that the home prices relative to wages are higher now than they've ever been in the history of the United States. Number 3 is total debt in the system. You can see this chart looks very much like that mortgage chart that we brought up. It starts here at 1950. We kind of go along this line, stays pretty much the same until we get to 1971. We go off the gold standard and it starts to increase. We get to 1981. That's the start of the interest rate bull market that we have for 40 years. And it really starts to go up. We hit 2000. And it goes up, 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 hockey stick curve again until we get to 2009. And then it flattens off a little, dips down, and then it goes back up to, again, we're at a higher level now than we were in 2009. And what I want to point out here is we had a recession right about here, and right here. And I purposely made these lines gradually bigger because the magnitude of those recessions increased. Why did the magnitude of those recessions increase? Because it was a debt deleveraging. So as the debt gets bigger, the size of the recession or the financial crisis gets bigger as well. Number 4 is interest rate cycles. And I touched on this briefly before in those last couple charts when we get to 1981. And you can see that long-term interest rates going back to the year 1798 go down, they go up, they go down. It's basically cycles, long-term cycles. And in 1981, we were way up at 14%, and interest rates have been going down to literally 0 until where we are now. So they've gone from 14% down to 0% over the last 35 to 40 years. So the question is not if, the question is when do we turn this corner and start to go back up for the next 20, 30, or 40 years. And why that's important to the housing market is because interest rates affect monthly mortgage payments. So the higher the interest rate, the higher your monthly mortgage payment is going to be. And you may say, well, George, back in these other interest rate cycles, it didn't really affect the prices of homes that much, and I would agree, but you got to remember, there wasn't that much mortgage debt in the system. Now we have exponentially more mortgage debt in the system. Go back to that last chart on mortgage debt. So the effect that the higher interest rates have over the entire housing market will also be exponentially greater. And I've saved the best for last. Reason number 5 as to why the current housing market is just as risky as it was in 2006. Drum roll, please. Because of real home prices. And when I say real home prices, I mean adjusted for inflation and size. We've got a chart right here going back to 1900. As you can see, we've got a little bit, going down in the Depression, going back and forth here in the 50s, 60s, staying pretty consistent. We get inflation in the 70s, we go up and down. We hit 1981 and they start to rise again, just like all the debt in the system. We get to 2000 and it just hockey sticks up to a point just before 2009. We go all the way back down. We hit a low in 2012. And now, as you know, we are at a point even higher than we were in 2006. And notice where we hit the low in 2012. Of course, it was just right along that historic trend line, which makes a lot of sense because home prices should reflect actual wages. And when you have a discrepancy between those home prices and those home wages, if credit stays consistent, sooner or later that discrepancy will have to revert to the mean, which it did right here. So as we all know, we were definitely in a bubble right there in 2009. So if we were in a bubble here, why on earth wouldn't we be in a bubble there if this is our historic trend line? And one thing that I wanted to address here, which just drives me absolutely crazy, is when people say that prices have recovered. You hear it on the financial media and online all the time. When people say, oh my gosh, well in my area, prices haven't even recovered to where they were in 2006, 2007, as though this is a recovery. This is the recovery. It's just like giving a person steroids and then going from 150 pounds up to, let's say, 250 pounds. And then they come off the juice. They come off the steroids and they go right back to 150 pounds. And then as they gain, let's say, another 5 pounds, they go 155. We say, oh, well, their weight hasn't recovered yet. You can't recover a weight or you can't recover a price that was phony to begin with.